What should you do if the stock market continues down? First, you should remember your goals, the reason why you're investing. Investments are meant to get you to a certain goal and compound over time for you to reach those goals. So if you don't have a purpose for your accounts, now's a great time to create a purpose and have a reason for your investments and what they're trying to get you towards. Secondly, keep dollar cost averaging. So if you're making contributions on an ongoing basis, this is what's called dollar cost averaging. You're putting money often and regularly into investments. So there's no reason to stop these things because you're now buying more shares with those dollars that are going in. So when things are on sale or the stock market's going down, your contributions are now purchasing more shares. And that'll help you compound your dollars for the future. The third thing you can do is rebalance your portfolio. So I'm a big fan of rebalancing on a set schedule. However, when markets fall, it could present a good opportunity for you to use those drawdowns to rebalance your portfolio back to your original target allocation. And this may be a good time where you realize that you're taking on too much risk and you go ahead and make a small pivot, not a big one, but a small pivot to get your portfolio in line with your risk tolerance. Or maybe you want to increase your risks. So this is a good time to potentially rebalance, get things back into more of an alignment with your overall target portfolio. The fourth thing you can do is tax loss harvesting. Now, you can use tax loss harvesting to rebalance your portfolio, as we said in the last step, or what you can really use it for is reducing the tax liability of your portfolio, meaning you can sell some investments that have gone down in value and replace those with other investments to keep your portfolio intact while taking the loss on the previous investment and using that towards potentially capital gains. Or if you don't have any gains, you can use up to $3,000 of losses against your income. The fifth thing you could possibly do is invest excess cash. Maybe you have excess cash lying around that you're not sure what to do with it. Maybe you just got a bonus. Maybe you just got a windfall. In any of these situations, if you have excess cash, it could be a good time to put those dollars at work by now investing in things that have gone down in value compared to where they were a couple of months ago. And lastly, Roth conversions. So if you're in a position to do Roth conversions, which is simply taking pre-tax dollars and pushing them into Roth accounts or after-tax dollars, this is a good time to potentially convert dollars because you're now able to convert a larger percent of traditional accounts into the Roth. Let me give you a quick example. Let's say that this year you're planning on converting $5,000 from your pre-tax or traditional account to the Roth account, okay? And your account value was $10,000 to start the year. Well, now let's say your account value has gone down 20% and now it's only worth $8,000. Well, originally you were going to convert $5,000 of the $10,000, which is 50% of the account. Now you can convert $5,000 of $8,000, which is a much larger percent of the account. So those are a couple of things that you can think about and consider when markets drop or the stock market falls.